Good morning. This is Chris Robinson, Robinson Ag Marketing with today's pre-opening grain comment for Thursday, August 14th, 2025. Beware of the Ides of March. Well, beware of the Ides of August, right? Overnight prices, corn down 4.5 cents, 392 and three quarters, and D's corn, sep corn, spot corn, 370. The low last night, 69 and a half. I'm still concerned about the old low in August, which would be a 5-year low in spot corn around 360 and a half, 360 a quarter. It's probably where this market's going to try and push. Volume in corn yesterday was very heavy. Some people are already started, step in there and hold their nose and try and call the low in corn. I think they're the same people that have been trying to call the high in cattle for the past 4 months. I don't get into that game. I don't know what the difference is to anybody. Stay hedged until you sell the corn. Nobody should be wanting to sell corn down here on these levels. You should want to be maintaining your hedges, which hopefully you put on earlier in the year. That's really what it comes down to. If you didn't, I still think you're better off probably buying a cheap put here rather than selling into the greedy hands of the people that have been waiting here. If we do hit that 360 level, there's going to be a lot of people stepping up to try and buy it because if you're Mexico, if you're a country that buys a lot of corn, why wouldn't you want to buy something when it's at 5-year lows? That's probably going to be our next big level, in my opinion, 360 in spot corn. Moving on to the beans. Um, couldn't punch through 1050. We hit 1049 a quarter last night. 12-cent range last night. We're at 5.75 cents lower. I'd wait and see how we trade here today. I think Friday's close is more important than anything. We did make a new high for the move last night, right? 1049 and a quarter. Um, the next old low that people are looking at is 1058. I would have used this rally to get to certainly 40% sold, if not 50% sold on guaranteed bushels. Why would you do that? Well, we've only had a dollar trading range all year, really, for actually 14 months, 960, and here we are, 1050, 1060. When you're at the top of that range, it's not the time to get greedy. It's the time to reward it. Can we go higher? Absolutely, positively, yes. But you need to defend this rally. We've come from 981 to 1049. That rally needs to be taken advantage of, rewarded. 60 cents in a year again when we've had a dollar trading range. That's why it's all relative. People say, "Why would you want to sell into it? Why would you want to sell into it?" Because um, we've seen how this market can turn quickly. Now, fundamentally, it looks like for sure we're probably not going to have enough beans. That was a big surprise in the acres for soybeans. So I'm not saying we can't go higher. Good Lord, I hope we go to $11. I hope we go to $12. But from a marketing standpoint, if I'm long beans and 6 days ago I was worried about 950 and we're getting 1050, you need to do something about it, brother. That's all I can tell you. Then the wheat, 4.5 lower overnight. December wheat hit 423 and a half, down 4.75 cents. Again, as corn goes, I think that's how wheat goes. That's a new low for the move. If 520 fails, it opens the door to 511 in December Chicago wheat, and I'd say the same thing across the board for Kansas City. If 520 fails in Kansas City D's overnight low 521 and a half, down 6.5 cents. That's a new contract low. People had thought that possibly this 525 level was going to be some sort of a halt. It certainly looks like both December KC and December Chicago look like when they want to go down and sniff around $5 and see what's down there. So maintain your hedges. That's all I can tell you. Moving on to cattle, kind of a wild day yesterday in cattle, 7-cent range once again. I think cattle is more of a money flow game than anything else. Everybody's aware of the fundamental situation. I read a story last night that for the first time, a lot of cattle producing nations, ourselves, Brazil, um, Australia, they're kind of all in the same phase of rebuilding a herd. I thought that was interesting. I try and read as much as I possibly can, just like you do, so I can share that stuff with you. But in that one author's opinion, um, he was actually kind of trying to give the case for continued bullishness. I go back because I'm chart based. I go back and look what happened in 2014 and 2015. Just like then, nobody got a text message that the top was in. We did start getting more volatile markets. That's key. More volatile days. When you start getting more volatility, you got more people that are sort of day trading this stuff. I was on RFD-TV yesterday talking, and I really, if I'm a producer, you don't want to be trading futures here already. You're already trading futures because you're long all the cattle you own. Why add to it by trading the board? Doesn't make any sense, especially in markets like this when we're moving 6, 7, 8 bucks every day. So yeah, I would definitely be defending these rallies. When the correction does come, it's going to be something where there's going to be three people out there that are going to write books saying, "Oh, if you follow my systems, you would turn $1,000 into $10 million." Some garbage type idea like that. That's complete nonsense. Those people always come up after every move. There's always some person that writes that book. I would say this: defend what you can, keep your upside open, stay disciplined, and I've been looking at the lean hogs too. April lean hogs, we've had a really good rally. We made a new run at contract highs in April 2026. We paused at that 90 cent level. Again, if you've got nothing on and you're a hog producer, back in April, just 4 months ago, we were down at 75. So how much is that 15 cents worth to you? Is it worth a 3 cent put to defend a big chunk of it? In my opinion, it is. If you're looking for help with how to manage this risk, how to keep your upside open, and also how to just stay stable and try and stay less emotional. These markets can be very, very, very upsetting. I understand it. I've been doing it since I was 21, 22 years old, and it can get very, very emotionally draining. That's why we hedge. It helps take some of the stress away from where the market's going to go, what's going to happen if the market does this, what if, what if, what if. That's what the hedge is for. So if you're looking for help, you may call 312-638-8868. Chris Robinson. We'll be back at it this afternoon. Have a great Thursday.